going to start the program now, a little bit about real estate. And I like that quote because that quote is very fitting for New York City. So here's a little bit of a roadmap of what the next 15, 16 minutes are going to look like. We're going to talk a little bit about how we got here in the past 5 years. What are the drivers we see in the market? Then we're going to talk into each one of the asset classes, and we're going to wrap it up with a watch list, and then we're going to get to the panel discussion. So what have we seen in the past 5 years? Well, in 2019, we saw the Housing Stability and Tenant Protection Act that devalued every rent-stabilized multifamily building in the city of New York, only to get into COVID-19, which reduced pricing and changed how we look at assets in general, real estate assets in general. Interest rates went to zero. Then we had inflation and the Fed interest rates, and these are the 5-year treasuries at their peak, affecting mortgage rates, bringing them from 3% all the way to almost 7%. What does that do? Creates a scenario where the volume of transaction is only $21 billion in the past 12 months. Just to give you perspective, it was $65 billion at the peak, and the average over the past 10 years is 35. So we're at a very low period of time when it comes to volume of transactions. But the last quarter showed us that there is some light at the end of the tunnel. Volume grew a bit, and that's because of the drivers we believe we see in the market. And here they are. The first one is mortgage maturities. There's about $900 billion nationwide maturing into a much higher interest rate environment and creating volume of transactions, forcing selling. The housing policy, which is a positive thing in New York City, finally created some clarity in New York City, which we believe is positive, and there's a tremendous amount of capital ready to invest because prices have come down considerably. You want to talk about office? Let's try that. Office market, growth in volume of transactions, not much growth, but a little bit of growth. And we've seen 3 elements that affect the office market. First, mortgage maturities. The second are owner-user purchases. And the third are conversions of office into residential. When it comes to mortgage maturities, we've seen 2 types, the distressed type and the Class A type. They behave differently. The distressed type are the likes of 1740 Broadway, which was purchased by Yellowstone from Blackstone in a deed in lieu with a special servicer. It was purchased at almost a 70% discount to the 2014 purchase. It was almost fully vacant, and it's going to be a conversion to residential. So it hits all the different drivers. But 1740 wasn't alone when it comes to mortgage maturities. There were 18 other properties that traded in the past 6 months, office buildings that were a result of some kind of distress. When it comes to maturities with Class A office buildings, where the location is great, the tenancy is there, the amenities are fantastic, landlords actually did something different. They recapitalized or refinanced and really held on to these properties. 10 East 53rd is a great example where SL Green not only managed to extend the loan for 3 years by buying it down a bit, but also wanted to buy out a partner at a lower basis. Shows you the conviction they have in Class A office as well as their lender's conviction. 425 Park that L&L owned, L&L managed to bring in a new lender to replace an existing loan. Again, conviction in Class A office. So you see the difference between Class A and those that are not. There have been about 10 transactions that are Class A in the past 6 months. Owner-user buildings. What happened in the past 6 months? We saw Bloomberg buying $560 million on Madison Avenue. 2 other companies did the same. But the past 2 years have been incredible when it comes to companies buying office buildings. And that's a trend that we believe we'll continue to see as a result of a lower basis. And lastly, we've seen conversions starting to happen, office conversions starting to happen. And that leads me to have a quick conversation about the development market. The development market grew to $2.2 billion of transactions, 25% of which is because of office conversions. One office conversion that we've heard the most of is the Pfizer building here on 42nd Street. It's going to be 15 units, partial conversion. But there were a total of 6 buildings that traded, office buildings that traded, that are going to turn from office to residential. At least that's what we're told. There's one more thing. The city created an accelerator program, and they're telling us that 60 landlords, office landlords, are speaking with them about converting their offices into residential. Office is not the only story when it comes to development. It's also about condominium developments. It's the residential market or residential development that we're going to see moving forward, and affordable housing development. In fact, in the past 6 months, we've seen some transactions that were pretty interesting. 31 prime locations of land traded for condominium conversions. That's a big deal in development, at least compared to the past few years. When it comes to rental development, what we've seen is 17 different or 18 different developments that had the vested 421A being purchased because the housing policy allowed for an extension to develop those over time, which is a big deal. We believe we'll see more land transactions as a result of the 485X, which is the new tax abatement based on the housing policy. And lastly, when it comes to affordable housing, the likes of 1760 3rd Avenue were interesting, where a dormitory is converted into supportive housing by a nonprofit being helped by a $160 million loan from the city. So all of that is happening in development, and it's creating a real dynamic development market, which we think is good for New York City. The market we kind of like the most, we're a little bit biased, is multifamily. And there was growth in volume of transactions there, mostly in the second quarter, but that's pretty good, or starts to be more normalized than before. When it comes to multifamily in New York, as opposed to Dallas, we have 3 different categories. We have free market, which is almost not regulated. We have rent stabilized, which is very regulated. You can't really increase rents there in a significant way. And we have affordable housing, where you have a lot of regulation, but also some alignment of incentives where you can increase rents through certain means or reduce expenses in a certain way. When it comes to the free market world, that is the most transaction aspect of multifamily, and that's because every single type of capital is interested in it. It's institutions, international, and private capital. When we looked at the institutional transactions in the past 6 months, they were pretty interesting. The first 2, 90 Cobb and 200 West 67, were purchased as a direct result of mortgage issues and maturities. The third one, not so much, but it shows you the depth of the institutional market when it comes to free market multifamily in New York City. International people are here too, be it Korea, be it Japan, be it Germany, and many others, and that's just the past 6 months. And private money. I know that some of the private investors are here in the crowd. They'll tell you they love free market, especially when it's smaller and it's tax class protected in Brooklyn, for example. And that's part of the reason they're buying it. So what are the real reasons they're buying free market multi, and why there's such a deep bench for free market? It's because of the fundamentals. The supply constraint in New York City pushes rents up in a substantial way, but the basis, the prices for free market buildings have come down a lot from its peak. So for example, in Manhattan below 96th Street, we used to see transactions closer to $1,000 per square foot back in the day. Today are closer to $700. So that's a substantial discount to peak, and that is also substantially below replacement cost and shows real value. Rent-stabilized housing doesn't have that deep of a bench. There, we see mostly one type of investor, and that's the private investor. The sellers there are selling for two main reasons. Number one, clearly mortgage maturities that are pushing selling. And number two are the strategic decisions. Those that said, we're done with rent-stabilized multi, we can't add value, and so on. There were 17 different transactions in rent-stabilized buildings in the past 6 months that were mortgage maturity driven. Our inventory at Ariel Property Advisors has a big portion of it in terms of note sales, deeds in lieu, and other sales that are related to mortgage maturities. And we believe that portion of the inventory will grow over time in the rent-stabilized sector. Strategic decision took place as well. So, for example, our team sold a $15 million Bronx portfolio for a partnership that said, we don't want to do rent stabilized anymore, or 1500 Noble that was sold for an institutional client by us. And they said, look, we can't add value to this asset anymore because of regulation. We're out. They didn't have to sell. What is also interesting is seeing the Parkov Organization, which is private money, buying or recapitalizing an institution, in this case JP Morgan, out of a bunch of rent-stabilized buildings and showing how the private money goes into these and replaces institutions. So why is private money investing so much in rent-stabilized multifamily? It's because of two main things. Number one, it's the lower basis. And number two, it's the belief that HSTPA, the regulation, is unsustainable the way it is today. When it comes to discounts or to bases, we can see these 6 transactions as an example of drops in pricing. These transactions traded pre-2019, and again in the past 6 months at discounts all the way up 60% in many cases. So that tells you that pricing is somewhat attractive. But when it comes to the changes in regulation, we've seen a glimpse of that, nothing major yet. The housing policy allows for a little bit more allowance to rehab vacant units, not significant, but an admission that landlords do need that extra money. And we've seen over the past few years some conversions of rent-stabilized complexes into affordable housing, which is helpful. But the city has to, they're not as of right. So if we had to think through what to do with rent stabilized, one of the solutions would be to provide incentives to convert many rent stabilized buildings into more of affordable housing and provide the alignment of interests that landlords need in order to operate these buildings. And these alignment of interests exist more so in affordable housing, not a tremendous amount of transactions in the past 6 months, but that's not because of lack of demand, mostly because of lack of supply. There, in affordable housing, there's that alignment between the government and mission-driven capital and affordable housing developers and operators, and we've seen that in 2 transactions. Treadway, the Tri-Houses portfolio for $90 million and committed $10 million in rehab so the lower income tenants could benefit from a better living conditions. They probably got, some increases in the project-based rents for that, which is where the alignment comes in. Or the Knickerbocker Village that was sold this year, and again, has to have some kind of incentives in the form of voucher tenancy that is allowing for higher rents. Can tell you that we have a considerable amount of affordable housing deals in our inventory, and we see the demand continues as long as that alignment of interest is there. So I'm going to talk about hotels and retail and industrial really quick. When it comes to hotels, we've seen a little decline in volume, but the fundamentals are solid. They're strong. The average daily rates are high, almost 90% occupancy, more business travel, more tourism, and less supply. So supply constraint. And we've seen that in transactions. They're about $500,000 all the way to $1 million a key. That's a big deal. Industrial, retail actually, before industrial, did $2 billion. That's a big number. That's because of Prada and Gucci and IKEA buying on Fifth Avenue. These are very specialized purchases, very similar to the office, but in a different way. We also, in retail, have seen some growth in rents in specific pockets and specific locations. Industrial, also growth there in 4 different pockets. Clearly the pockets of industrial, which are logistics, self-storage, data center, and film studios, 3 of which had major transactions in the past 6 months. We believe New York will keep benefiting from these kind of transactions in the industrial sector as we move along. That leads me to wrap it up with our watch list. The first thing to watch for, in our opinion, is mortgage maturities. There's $4.7 trillion. Trillion is a big number, very hard to comprehend, of outstanding mortgages nationwide. And they're going to mature in the next years in a probably much higher interest rate environment. The next thing is clearly the abundance of capital. These are just a few companies that are raising billions of dollars to invest in real estate. That's helpful. There's uncertainty when it comes to the presidential elections and geopolitical risks. We have to be aware of that. Interest rates, we hope, are on their way down. We'll know after 2 o'clock today, but we hope they're on their way down. The city of Yes is another housing policy positive that, if goes through, will be a benefit to New York City. So mortgage maturities are going to create more volume of transactions. The same with the housing policy, more volume of transactions. Pricing have gone down so much that that capital that was raised is probably going to start investing in a bigger way. And that's the reason why we think we're going to start seeing more volume and more transactions and more activity in the next 12 months. And as brokers and intermediaries, it does make us happy. I want to thank you. That's my presentation. And I'd like to invite the panelists to come aboard and let's get the show on the road. Thank you. Thank you. Thank you. Thank you. Thank you, Chris. Awesome. All right. So this is my office today. It's here. And I'd like to first thank you all for being here. And why don't we jump in and introduce each other, and each one of you introduce themselves and their companies. And Ralph, why don't we start with you, and thank you again for hosting. It's amazing what you've done for us.
Well, thank you. It's wonderful that we're all here together in this space. And Shimon, the work that you've done over many years in this space has been tremendous. It's wonderful that we're partnering together. And really the important part was legal outreach, really making that connection, bringing that forward, supporting the efforts and the hard work that's conducted every day. And we all saw that in the students here. A bright future for sure, and we want you to know that there's a lot of encouragement, especially in this room. Welcome everyone to this great space. We're very proud of it. We are the anchor tenant in this building. You see our retail presence throughout New York City. I'm responsible for the commercial business here in New York City. Many of my bankers are here today. We cover everything from small businesses all the way up to mid-size companies. We have a fair amount of real estate within the portfolio. But I do want to make a mention of Mark Melchioni is here with us, who runs our real estate group. Mark, if you could stand up for a second to the audience. He is really the main focus of our real estate efforts here throughout the metropolitan area and even a few other significant markets for the bank. And so welcome, Mark. Mark has newly joined TD, so glad you're joining us here today. And Shimon, I'm really glad you mentioned my relationship with Mike Stoller, because it really, my introduction to real estate was really through events like this and searching out mentors like Michael, who has really made an effort to educate me around real estate. It still hasn't sunk in, Michael, too much, but it's working that way. So I really liked your watch list. that you had. I think those are all, from my perspective, those are the items that are top of mind for me. Certainly the maturities, the interest rate environment, and the effects of inflation on operating expenses, I think has really been an issue for us, and when we're looking at refinancing some of these maturities that are coming about. So thank you all. Welcome to TD Bank. I'm glad you're here today.
Thank you. Thank you, Ralph. Chris,
Hi, my name is Chris Albanese.
it's working.
We're developers. We've been building in the New York area for 70 years. Apartments, market rate apartments, affordable condos, office buildings, hotels. Historically in New York, Long Island, Jersey, we've recently gone upstate. We have a big project up in Syracuse, looking in Buffalo. Happy to be here.
Thank you.
Hi, everyone.
See if that works. Try now.
Hi, everyone. Pleasure to be here. My name's Jasper from ZD Jasper Realty. We're a family-owned development company based in New York. We do primarily ground-up residential development, a mix of condos and rentals. Historically, most of our portfolio has been centered around Long Island City, Queens area, Astoria, Jamaica, but recently we have been expanding into Manhattan, Hudson Yards, Upper East Side. We cover all aspects of the development cycle, so I get involved in everything from underwriting, zoning, to in-house general contracting, so job site issues like neighbors or DOB inspections, even physical labor if needed. So pleasure to be here. Thanks to Shimon for inviting us.
Thank you. Ralph, why don't we start with you? We talked about the mortgage maturities and liquidity and all that good stuff. And I know TD is actually a strong bank. We know that you have a tremendous amount of deposits and relationships and so on. What are you focusing on today when it comes to real estate? What are you focusing on when it comes to lending in general? How do you view the world in today's market?
Sure, thank you. I would say the key to that is the word relationship that you used. I think that is the primary driver for us in how we evaluate where we go with the transaction, who's behind it, how much liquidity is there, what is the prospects of opportunity for both the sponsor and for the bank. I think that's key for us. And then the underwriting fundamentals is critical. We've had a fair amount of success even into this slower period that you highlighted during the slides over these past 7-8 months of new transactions throughout the 5 boroughs. So certainly in the multifamily space, the mixed use space, I think, is also very attractive for us. And so that's kind of been a key component for us to drive business through that segment of the portfolio.
Thank you. And since we have 2 developers here, why don't we talk a little bit about your take of the development market today? Maybe tell us a little bit how you feel about the housing policy. You think it's helpful? You think it's just okay? How do you, I see Chris is smiling because I'm not sure if he wants to develop in New York anymore. He wants to go to Jersey or wants to go upstate. So Chris, why don't you tell us a little bit about your thought process? I know you're developing also affordable housing, which requires a lot less specific equity and more subsidies and know-how. So it's a little bit different. So tell us a little bit how you feel about the development market today.
Sure. We've created a big problem in New York. There's a severe shortage of housing, and the politicians have focused mostly on rent-controlled rent stabilization and keeping rents down for those who have apartments. But if you look at the charts, the amount of housing we're building in New York goes down year after year. And, other jurisdictions don't do that. The fact that 421A expired and it took 2 years to replace it. So that meant for 2 years there were no new projects. In a city as large as Manhattan, it's terrible. You can't stop building for 2 years and expect to catch up at a later date. During the Bloomberg administration, a lot of rezonings, a lot of new housing, very friendly to developers. And under de Blasio, that changed. Things became more difficult. The building department, going through a rezoning. I would never go through a rezoning in New York. It's just too difficult. The local politicians want to know what's in it for them, and it just stifles, new supply. COVID is a good example. When COVID happened, rents in, say, Chelsea were 70 to 75 a foot. COVID happened, demand plummeted overnight. Rents went down significantly to the 50s, which we hadn't seen rents that low in 20 years. Bars and restaurants opened, young people flooded back, rents went back up to 75. Now those same rents are over $100 a foot. Why? We don't have enough supply. And there's no way to fix it other than build more apartments, and we're not doing it. The new 485X, it's good that they brought back a version of it. I think you'll see less built under 485X than under 421A. There are more requirements, so the numbers are tighter. And, it's good that we have an office conversion law that just passed. Again, I think it should have been done sooner, but, these things do take time. That will create apartments. I don't know how Manhattan and New York City build enough apartments over the next 10 years in the current environment. And so rents will just keep on going up, which is a bad thing for New York. And I'm a developer, and I'm saying that.
Yeah, that's super interesting because we feel the same way, and we showed it in the numbers. I mean, the supply constraint creates pressure on free market apartments, and it's not about regulation. You can't regulate your way out of shortage of apartments. And the housing policy, as you said, is good, but we're hearing the same thing, that for larger buildings, the 485X doesn't necessarily make economic sense. Now, I want to stay with you for a second, Chris, because one of the things I know about you is that you guys were a pioneer in Jersey City. I think so, right?
We have 3 large projects in Jersey City. We're not pioneers there. Others were there first, but what's
the difference?
Right. So in Manhattan, I think the public thinks that pilots' tax abatements are just to make developers richer. Nothing could be further from the truth. In New York City, the real estate taxes are 30% of your gross. It is not possible to build a building when, if you open up, you're paying 30% of your gross, not your net, your gross, to the government. No other jurisdiction has that. And that's why tax abatements are the only way to build buildings in New York City. We crossed the river to Jersey City because you can build there at a reasonable return without a tax abatement. The taxes there are 15% of your gross. That's half. Yeah. Construction costs in Jersey City, the same building that would cost me $300 a foot to build in Jersey City would cost $600 a foot to build in Manhattan. Think about that. Double. Now, if you have a real good arm, you could probably stand on the West Side Highway and hit Jersey City with a baseball. It's less than a mile, but that's a reality. Those are the cost differences. Now, rents are higher in New York, but not enough to make up that difference. And that's why we branched out to Jersey City. We're going upstate. Austin is a great example. Austin has an oversupply of apartments right now. Rents are coming down. You want to bring rents down. We developers will cut each other's throats to build more apartments to our detriment, but it will increase supply and bring down rents. We're not allowed to do that in Manhattan. I would say 10, 15 years ago, if you were going to go through a zoning change, ULURP, you could assume 2 years. Now, it's impossible. It's just impossible. We'll see if the city of Yes goes through, but I wouldn't touch a development site if I had to go through ULURP. It would be 4 years and probably not be successful.
Wow, that's impressive. That's a lot. Jasper, same question, kind of where do you see the market given the housing policy? You've been very dynamic in buying land in the past 5-6 years and developing both condos and rentals. So you have that perspective. I think you do a little bit smaller buildings or such. And I'm curious to know, where do you see us as a city moving forward? Where do you see opportunity?
Yeah. So our average building size ranges from anywhere between 30 to 200 units, probably around 100 units on average at this point. I think it's a pretty interesting time in the development, investment, sales market. Everyone knows rents are at record highs, vacancies at record lows right now. But surprisingly, land is not expensive at this point. I feel like you can find deals. I think what's changed is that the interest environment is so elevated, so the pool of buyers it's much smaller. You have much less people who are able to execute and close on land. So right now it's kind of this interesting time. Like you can find deals. I think with 485X, it is definitely a much different program than 421A. The AMI levels are 60, 80 instead of what it was before 130, which I think people knew was going to happen at some point. 130 was pretty generous in the past. But more concerning for developers is definitely the construction wage requirement. These are very material increases in minimum construction wage, especially for larger projects. For us, it would lead to increases of hard costs anywhere between 20 and 30%. So we'll have to see how it plays out. It's still very early in the game right now. Still some implementation details to be worked out. But I think for us, I think we're probably a little bit more bullish on New York City. We feel everything's cyclical, so New York City will come back in the end. Whether you see that in the form of more 99-unit buildings to get under the wage requirement or more 99-unit buildings combined together to make a bigger building, which is possible. I think regardless of what happens, it's only a matter of time before the market bounces back. So right now is a good time to act if you can, but I think it'll come back. I think in the next year or so, we're going to see a surge of new filings. And again, we're happy that there's something in place, even for developers, but also for lenders, to have some kind of certainty there. I think everyone can agree that's the right step in the right direction.
A little bit more clarity. Ralph?
Yeah, I just want to piggyback off of the city of Yes, kind of encouraging from my perspective on that at the state and at the local level, we do have the attention of the legislature to really act and really address the capacity issue, and that's something that's critical for us. So I'm optimistic from what we're seeing. I think it's gaining some momentum. The shooting match is really going to be in the fall and how that all plays out. But I think the components of the city of Yes will address a lot of the capacity issues that are needed here in the city.
Thank you. And Ralph, since we're with you now, look, you've been in the industry for long enough to see many different things. I mean, we've seen an increase in interest rates we haven't seen in 20 years. And presumably the past 20 years were an anomaly, but it's been 20 years of very low interest rates. How do you compare what we're seeing today to anything else you've seen before? Can you compare it? How do you think about this even?
So I'm not going to make references because then I'll date myself. So I'm going to try to avoid that. But I think when I look around the room, I see a lot of young professionals here. So you haven't seen anything like this. There has been times, whether it was in the industrial segment or in construction, that has really been severe downturns here in the city. This is unique in the sense that no one expected 550 basis point rise in rates. Inflation that was supposed to be transitory didn't really play out that way. We all experienced that as we went to the grocery store, and then it's just played out even more. And then I was recently talking to an executive at an insurance firm, and this is unprecedented times for them. The cost of insurance is just out of control. So there's a lot to kind of still work through. I think with some opportunities of a lower rate environment, but how do we deal with just the higher cost is going to continue to put a strain on our ability to underwrite, certainly with these looming maturities. So it's certainly going to be continued challenging times, but deals are still getting done. Opportunity, you saw when you put up those big names there about capital being allocated to this sector. So I'm encouraged that we'll kind of break through this cycle and onto the next.
Thank you. And, since we were talking about leverage and about, construction loans and equity, let's deal with that a little bit. to the extent that it's relevant for you guys, Chris and Jasper. It's harder to finance today. I mean, I don't know. Do you use your own equity, or you go out for equity partners? I mean, I can call it the B of A, right? Bank of Albany.
No, no Bank of Albany. We all of our projects are done with institutional partners because they're very large projects, and we have a project in Jersey City where well, hopefully we're breaking ground this year. All the equity funds, the Starwoods, Rockwoods, et cetera, they've put out very little equity. They've all been very risk adverse, and when you think about it, it started. Clearly, during COVID, very little got out, then things calmed down, and then the interest rates went up. So most of these firms are sitting on billions in dollars of money ready to put out. And because really very few of them want to do new construction, they find it's too risky given where interest rates are and the rate of return, the dam has to break. So my guess is if the Fed start lowering rates, you're going to see a lot more new construction because the institutional funds will start putting out money. Construction loans aren't a problem. They're a lot more expensive than they were, obviously. But if you're a good developer with a good project, there are loans out there. But again, the equity is on the sidelines. But it will change. I agree. But we're still not going to be able to build enough housing in New York to keep up with what we need to be. I mean, in Washington, D.C., a one-bedroom in a nice building in a good neighborhood is $3,000. In Manhattan, it's $6,000. So how do, I'm talking about for luxury doorman buildings, it's double. How do the 20-year-olds live in Manhattan? It's very tough.
With a lot of roommates.
With a lot of roommates and with help from their parents.
That's
I mean, when I graduated college, I didn't need to, rents were cheap. You didn't need to get, help from your parents to pay your rent. Now it's almost mandatory.
Yeah. Jasper, you use equity for?
Yeah, so we haven't had the chance to use institutional equity at this point. For us, we're still a newer player, a smaller player, so most of our equity is a mix of our own balance sheet plus private investors plus friends and family. We always use construction loans. Construction financing is there. I think what's really changed in the past is everything's more expensive, of course, but the gap between bank lending, traditional financing versus private lenders has shrunk. Right now, bank lending is probably 8-9% all in for a construction loan, and private financing is 11-12%. So you can get more out of private financing, and it's non-recourse. So we're seeing the trend in that direction. But I think financing is still there. It's still expensive, but we've been fortunate to work with a variety of lenders. So as long as the sponsorship's good, the project's good, it's still there, but it's just more expensive.
It's more expensive. Like everything else is more expensive. Even hard costs are a lot more expensive today. I mean, how do you deal with that? I mean, what do you do? I mean,
well, hard costs actually came down.
Okay, let's talk about it.
We broke ground a year and a half ago on a 200-unit building in Suffolk County, affordable housing, and it was the first time in ages where all the major trades came in below our budget. So because of what's happening in New York and Long Island, the lack of construction, there was a dip in hard costs, but they're on their way back up.
Yeah.
But listen, it's expensive to build in New York, but the rents are high. So
it mitigates it a bit.
The post-COVID drop in construction helped level off costs. I think costs hit their highest in November, December of 2022. And then the brakes hit as far as new construction, and costs started coming down.
Yeah, I would echo the same idea. Like, costs are not what they were before. I deal with a lot of subcontractors every day, and right now there is work out there. It's not like subcontractors are just picking and choosing who they want to work with. There is room to negotiate. How we mitigate is we have a pool of about 2 to 3 subs that we usually work with, and we rotate through the pool, and that way it keeps everybody honest on pricing. There are other programs, I think, that would help. One program that gets tossed around a lot is CPACE, the I forget what it stands for, but it's essentially a tax on a way of financing energy efficient upgrades. That program has been active in a lot of other states in the U.S., but it hasn't really took off in New York City yet for a variety of reasons. But once that program takes off, I think you're going to see a lot of developers flock to it. It's a huge help to your capital stack.
Yeah, it's interesting. CPACE is super interesting, and our capital services group is positioned in that. And we agree with you that it hasn't taken off in New York yet. And, you know, since we have you here, let's talk a little bit about condos versus rentals. I know you just bought a deal, I think, in Long Island City. Is that going to be a condo deal, and how do you make that decision?
Yep. So the deal you're referencing is 4540 Vernon Boulevard in Long Island City, $47 million purchase we closed on about 3 months ago. That's going to be a very exciting project. I live in that area myself, so I've walked by that building like 100 different times. Never thought we'd be the ones developing it, but very exciting project, very complex project as well. At this point, it will most likely be condominiums. And then how we usually make that distinction is it depends a lot on location, on a case-by-case basis. For example, we do a lot of development in Jamaica. We have 4 or 5 buildings done in Jamaica. Jamaica, the rents are surprisingly strong, surprisingly robust, but there's absolutely no condo market, so you have to do rentals there. In Long Island City, we have a lot of projects. It can kind of go both ways, rentals and condos, but we usually feel pretty comfortable with condos, given the inventory. In Long Island City, for every 10 units that are built, 9 are rentals, so we feel strong that there's always going to be the demand. So there's going to be a supply constraint for condominiums. For other projects, it depends on various things like the political environment. We closed on a couple of pieces of land around the middle of 2022, back when 420A was just about to sunset. And for those projects, we pretty much had no choice. We can't carry it that long, so we have to do condominiums. So I think it's a combination, like location, the type of inventory that's in the market, the type of capital that we have available, and also the political climate.
Got it. And since you talked a little bit about political climate, Chris, I know you guys jumped into affordable housing, affordable development in the past few years or even before. Want to talk a little bit about it, where you see the opportunity there?
Sure. About 10 years ago, we jumped into affordable housing. It was a good way to diversify. I really enjoyed being in affordable housing. We have numerous projects, Suffolk County, Brooklyn, Bronx, Syracuse, and there it's not an easy business, but the constraint there is the federal subsidies and tax exempt bonds. So right now, if you tie up a site in Manhattan, Brooklyn, Bronx, so the way the affordable housing gets built is rents are at 60% of AMI on average, and in order to build it, you're getting tax credits, tax exempt bonds, and other subsidies from the state and the city. So the bottleneck there is New York State, and every state only gets a certain amount of tax exempt bonds allocated per year to their state. And so, for example, in New York City, if you tie up a piece of property, the waiting list is 4 to 5 years to build an affordable housing project. It didn't used to be that way. With New York State, it's more like 3 years, but the Congress really needs to change some legislation, which has been discussed, so that the states have more resources to do these projects. And then the projects we build, they don't look like affordable housing projects. They're very nice apartment buildings with beautiful apartments on the inside. And, for us, it's been, again, a way to diversify. And now our affordable housing projects, because of where we are in the economy, we have more going on than market rate. But that'll change in a few years.
And that goes back to your point of supply of housing. 4 years to wait for an affordable housing financing and funding from the government. That's
right.
A long time. I wish
it is. Yeah. It is. But listen, there's a demand on resources on both the federal and state level, and population is growing. And like market rate housing, we're just not keeping up.
I want to ask you guys, all of you, and maybe start with Ralph. During the presentation, as a broker, I presented a very rosy outlook of volume of transactions, which is kind of what we like to do. Ralph, we'll start with you. How do you feel about us New York City moving forward? Where are we going to find ourselves a year from now, sitting here talking again, to the extent that you can think it through and be realistic, or optimistic like me, but not pessimistic?
Not in my nature, but
Here you go.
Rosie. So, eyes of the beholder. I think we have some real challenges ahead of us, but nothing that can't be addressed. We see some real talented executives here or out there, really making a difference within the asset classes that they know and understand and want to continue to develop. I think with some of the support out of the state and out of the city that we see, I think that's going to create opportunity for us, a little bit of a softening in rates. I think will provide some relief, but I think there also is going to be a little bit of an economic slowdown. That's just a natural kind of evolution of how the economy works, and I think that's kind of been building up steam at the consumer level. So always a bunch of challenges that we have to kind of put in our basket and kind of consider. That is going to make a lot of those upcoming maturities a challenge for institutions to absorb and find the right money. But I think we talked a little bit about alternative financing, and I think that's a robust field. So my vision over the next several quarters, I think, will continue to be optimistic with challenges and some real hurdles within certain asset classes.
Thank you. And Chris, optimistic, pessimistic, in the middle?
Very optimistic. New York is the greatest city in the country. And, every time something happens, there's so much negative talk about New York, crime after 9/11, after the tech bust in 2001, and now post-COVID, more homelessness. When you go around the country and you look at other cities, there's nothing like Manhattan and New York City. We looked at doing deals in Austin, Tampa, Atlanta, Raleigh. They just don't compare to Manhattan. And the young people, the 20 and 30-year-olds, the talent, the ones who fill up the rental apartments, they want to be in major cities like New York and DC, Boston, and a few others. You go down to, say, Tampa or Austin, they're very nice cities, but you can walk from one end of Austin to the other in 10 minutes. They're very small cities that don't offer what New York has. So there's no question there are a lot of B and C buildings where the banks are going to get hurt. The owner's going to give back the keys. There's going to be a lot of litigation, and that will take time to unwind itself. But better banks like TD Bank don't have that problem because they're not overexposed in office buildings. But New York will continue to grow, and the young people want to be here. My daughter lived in Houston for 2 years because her job took her there. And you just can't compare cities like that with Manhattan. The talent, they get out of college, post-COVID, they're very lonely because, of social media and what happened during COVID. And now they want to be in vibrant urban areas. And there's no better vibrant urban area than New York.
Yeah, it's good that our Dallas partner from GREA is here and not our Houston partner. GREA is here, but yeah, I hear you. There's nothing like, we agree, there's nothing like New York City. And Jasper, what do you think?
Yeah, I agree. And I'm we have multiple projects in the pipeline for delivery in 2025 and 2026. So I kind of have to be optimistic. be bad for me to be pessimistic. Yeah, I think there's a lot to be, it's a lull right now. There's no doubt about it, but there are a lot of things to look forward to. It's activation of CPACE, as I discussed before. City of Yes, hopefully it gets passed in the fall. That'll be a huge boon to developers and building housing. So, and New York City always comes back. Developers always find a way with this new tax abatement. There'll always be a way forward for us.
And say, Jasper, you're very smart to be doing condos now, because when you open those buildings, there's going to be no new supply. And we looked at a few condo projects. Our partners weren't interested because, risk reward analysis. But you break ground now for a condo and you open up in 2-3 years, you're going to hit a home run. There's just not enough new supply.
Yeah, I hope so.
That's great. I have a question. So one of the things that we've shown on development was, I have a feeling I know the answer, but office conversions. All right. So Will you lend on office conversion? Will you do office conversions?
This is a personal opinion. Office conversions are challenging. I think it's going to be very difficult to finance. But we saw some of the way the transactions have been structured. There could be a potential for senior financing in the capital stack. Let's see.
They are very difficult. We've looked at a number of them. We have not pulled the trigger. There are two large projects going on downtown now, and not to be negative, but I think those two projects are going to have a tough time when they open up with the numbers that they need. People are throwing around $100 a foot. Yes, rents are $100 a foot, but not when your apartment is looking into a brick wall and it's a 700 square foot studio with one small window. So the bigger office buildings are difficult to convert. I think we're going to see a lot of the smaller office buildings, side street office buildings, 100,000, 200,000 square feet. I think you're going to see a lot of these buildings get knocked down and new apartment buildings get built, because I think we're getting to the point where these B and C office buildings are worth less than the land. And think about it. A lot of them were built in the 30s, 40s, 50s. These buildings are 80 years old. They're obsolete.
That's right.
And that's why a building like this gets $250 a foot, and you have buildings on 3rd Avenue that are 40% vacant. They have the 8.5-foot ceilings. They don't have the window, inferior location. I think we're going to be surprised by how many buildings start to get knocked down.
Thank you.
Yeah, I would agree. I see an office to residential conversion across my desk probably once a week. And these, demolition in New York City is really not that expensive. And I think with these, maybe they look good on paper, but with these kind of conversions, you always run into unexpected issues, unexpected costs. So you go through all this trouble and you end up with not a high efficiency product and not a high efficiency building. So, for me, it never really appealed to us.
Thank you. I think what I'd like to do is just get some closing words from each of you. And so we'll have some more time to network and say hi to people here. Is that okay? Sure. Ralph, why don't you tell us where we're going to be again, and how do you see life in general?
Well, first, I just want to thank you for a wonderful program today. Thank you to Outreach. Thank you to my team for really supporting this event. Natalie Wolf was probably not here, was key to this. So thank you all for this. I hope we get the opportunity to do this again. Like I said before, I'm optimistic. I think there's a lot of opportunity. We are a bank that is growing. We are strong, well-capitalized, liquid. We're going to continue to bet on New York because we believe in New York. We build. Our portfolios will continue to thrive. Our retail network will continue to grow. So I'm really optimistic. We're betting heavily on New York City, and we're counting on all of you to deliver for us. So thank you.
Thank you.
Shimon, likewise, thank you for having me. And this is a great event that you put together. I'm very optimistic about New York and the future of New York. The Feds have to lower interest rates. And they're very focused on bringing down inflation, which is a good thing, but they understand that, the average person spends 30 to 35% of their income on either rent or mortgage payments. And, new homes are more expensive, apartments are more expensive. And when they start to bring down interest rates, even if inflation doesn't do what they want it to do, it's going to lower people's cost of living because of their rent and their mortgage payments. So that's really a must. And I think they are. And I think we're going to see more real estate activity in 25 and 26 because rates are coming down.
Yeah. So again, thank you, Shimon, for inviting us. I know we're a younger company, a newer company, so it's really an honor to be here. I think there are a lot of positive things to be on the lookout for. 4085X is here for the next 10 years. We don't have to worry about that. City of Yes is on the horizon, hopefully, and we didn't talk about it so much today, but there are a lot of very positive things to be excited about in City of Yes. So I'm optimistic. I'm fully invested. So look forward to it.
I'm happy to see that the three panelists are as optimistic, if not more optimistic than me in New York City. And I'd like to thank first our sponsor, TD Bank and Ralph Bumbaca, Chris Albanese, and Jasper Wu. Thank you so much, everybody. Please stay. We're going to have some more food and drinks. Thank you.